Welcome to The Explainer. Today we're putting on our detective hats. We're launching a full financial investigation into a company with honestly one of the most confusing market presence out there. I'm talking about Roper Technologies. Now on the surface, things look pretty contradictory with this one, but we're going to break down the hard facts. We'll deconstruct the business model and figure out what on earth is actually going on behind the ticker symbol.
Right off the bat, let's look at this bizarre paradox. If you pull up the recent data, you're going to see a stock that is absolutely on fire. It's up over 17% in a single month and almost 24% over 3 months. But zoom out and the picture totally flips. Roper's actually down over 15% for the past year and down nearly 14% over the last 5 years. So you got to wonder, what changed here? Did Wall Street suddenly discover some hidden gem, or is this just a temporary bounce inside a much larger valuation problem?
To figure that out, we really have to ask the most foundational question. What exactly are you getting when you buy a share of Roper? Because look, this isn't your standard tech company building the next viral consumer app. It's actually a massive collection of specialized software and tech businesses, all pieced together through a really aggressive acquisition strategy. So is this a flawless wealth compounding machine? Or is it an expensive acquisition engine that's finally starting to sputter? Let's dig in and find out.
Section 1. Under the hood. Deconstructing the Roper machine. Let's see how this thing actually works. So, Roper operates through a portfolio of specialized businesses, and they divide these into 3 main segments: application software, network software, and technology-enabled products. But what's really fascinating here is the sheer dominance of the application software side. In 2025, that segment alone pulled in nearly $4.48 billion. That is almost 57% of their total company revenue.
And that software dominance? It's absolutely vital because it produces a holy grail of finance, which is recurring revenue. Think about it. Customers don't just buy a software license once and then walk away forever. They subscribe. They continuously pay for the software and the services they literally need to keep the lights on and run their daily operations. It creates this incredibly predictable, highly attractive stream of cash. But generating revenue from existing customers, well, that's only half of Roper's playbook.
The other half is this massive, relentless acquisition engine. Over just 3 years, Roper deployed a staggering $8.96 billion toward buying up other companies. In 2025 alone, they spent about $3.3 billion scooping up businesses like Central Region Subsplash. The strategy is super simple in theory. You buy mature, niche companies, you fix them up, you harvest all their cash, and then you turn around and use that cash to buy the next one.
And honestly, at first glance, this strategy puts up some fantastic numbers. Take their 2025 total revenue growth. They grew their top line by 12.3%, jumping from just over $7 billion up to $7.9 billion. I mean, that looks incredibly impressive on an earnings release, right? But since we're acting as financial detectives today, we need to dig a bit deeper and separate where that growth actually came from.
When we split that 12.3% figure apart, the reality shifts a bit. Acquisitions drove 6.7 percentage points of that growth, while organic growth, meaning the businesses Roper already owned, was only 5.4%. This clearly shows the heavy lifting is being done by their checkbook, not necessarily their existing products. Now, to be fair, 5.4% organic growth across mature niche businesses isn't bad at all, but it does prove just how reliant they are on literally buying their revenue.
Which leads us to a massive, absolutely critical question. What happens when the acquisition machine gets too expensive? If your whole model relies on buying growth, your entire foundation is threatened if high-quality target companies start demanding sky-high purchase prices. Keep this crucial risk in the back of your mind as we move into their recent financials.
Section 2. The earnings illusion, reading past the headlines.
Okay, if you were reading the financial news for Q2 of 2026, you almost certainly saw this massive, eye-popping number, 209%. Roper's reported net earnings exploded by roughly 209%, hitting $1.169 billion compared to just $378 million the year before. For a casual investor, this screams explosive operating success. You'd think their software sales just went entirely through the roof, right? Well, wrong.
Here is the truth bomb. In that exact same quarter, Roper recorded an $835.2 million net gain from an equity investment. The previous year, that gain was only about $16 million. So that massive 209% jump, it was largely an illusion, a one-time windfall. It was not a reflection of their day-to-day operating performance, which, for the record, actually grew by a much more grounded 6.6%.
So the crucial lesson for us here is this. You absolutely must separate operating performance from investment gains. A one-time, volatile investment gain looks fantastic on paper, sure, but it doesn't create the reliable, recurring cash flow a company actually needs to survive and grow. To understand the true health of the Roper machine, we really have to look past the flashy headline earnings and focus entirely on the cash.
Which brings us to Section 3, the balancing act, cash flow versus the debt pile.
Now here is a genuine, undeniable strength for Roper. For the first 6 months of 2026, they generated just over $1 billion, $1.062 billion to be exact, in operating cash flow. That is up 13.8% from the exact same period the year prior. This cash generation is literally the lifeblood of the company. It's what allows them to go out and buy new businesses, pay out dividends, and repurchase their shares. But against that strong cash flow, you really have to consider the towering debt they're carrying around. As of June 30th, 2026, Roper had over $11.3 billion in total debt, but only $365 million in cash on hand. Do the math, and that leaves a net debt of roughly $10.9 billion. And what's more, that net debt actually rose by about $1.95 billion in just 6 short months. So yes, they make a ton of cash, but they also owe a tremendous amount of money to fund this acquisition habit.
So where else is all this cash going? Well, aggressive shareholder returns. In just the first half of 2026, they spent over $2.7 billion repurchasing their own shares. They also boast an incredible 33 consecutive years of annual dividend increases, currently paying out $3.64 annually per share. Now, reducing the share count and growing dividends sounds awesome, but remember this: buying back your own stock with cash, or even worse, with debt, is only a smart move if you aren't overpaying for it in the first place.
So, despite this debt load, why do long-term investors still revere Roper? Well, it comes down to their secret weapon, a relentless focus on boring, essential niche markets. Their software gets so deeply embedded into their customers' daily workflows that it creates extremely high switching costs. I mean, it's a huge pain to change software. That gives Roper immense pricing power and really strong cash conversion. They don't want to be the next flashy social media app. They want to be the invisible plumbing that a business literally cannot operate without.
But there is a wild card looming on the horizon, and that's artificial intelligence. You have to ask, could AI disrupt this well-oiled software machine? If AI suddenly makes it incredibly cheap and easy for competitors to build specialized applications, that competitive moat protecting Roper's niche software, it could just evaporate. And to be fair, Roper acknowledges this themselves. AI is both a massive opportunity to enhance their current portfolio and a very real existential threat to their acquired advantages.
Section 4. The final verdict, synthesizing the bull and bear case. Let's bring all these clues together.
Let's start with the bull case. The argument for Roper is really one of consistent compounding. You're looking at a business producing 5.4% organic growth and 12.3% total revenue growth, all backed by over $2.5 billion in annual free cash flow back in 2025. You have highly recurring revenue that's spread out across diversified, essential niche businesses, plus this incredible multi-decade track record of rewarding shareholders with dividends. It's a machine built to run, for sure. But you know, the bear case is equally compelling here. You simply cannot ignore roughly $11 billion in net debt, especially in an environment where interest expenses take a real bite out of the bottom line. The company is heavily dependent on acquisitions to drive that flashy headline growth, which kind of masks the slower organic growth underneath. And most dangerously, if they're forced to pay high purchase prices for their targets, it can outright destroy the returns that make this whole compounding model work in the first place.
Taking both sides into account, our investigation leads us to a final verdict of watch or maybe a selective buy. The business quality and the cash flow generation are undeniably strong, no doubt about it, but that debt load and the current valuation absolutely demand strict caution. Before you jump in, you really need to watch key metrics like organic revenue growth, free cash flow per share, and those net debt levels, just to ensure they're actually generating value and not just buying it at a huge premium.
Which leaves us with one final thought for you to take away from this explainer today. Roper the business is an excellent cash-generating machine, but Roper the stock is entirely dependent on the price you pay for it. So ask yourself, are you paying a premium for a compounding machine? And if so, is that machine robust enough to justify the price tag in a rapidly changing AI-driven future? Definitely keep that in mind as you do your own research. Thanks so much for joining us.